So Tell Sheet 12 is having an incredible existence. I implemented this model back on June 16th of this year, and it is up an incredible amount. The way the Tell Sheet 12 works is there's 12 companies that have been screened out using my proprietary quantitative model and on Carrie's Tell Sheet stocks. So there's roughly 60 or so stocks on his Tell Sheet as well as his watch list, as well as his mining crypto stocks. And I screened that out using a quantitative model that I've been working on for probably what 5, 6 years now. And it identifies basically a group of stocks within that list, and then I use a qualitative measures in that I apply as well, and I bring it down to 12. So when I implemented it as of the close of business, stock prices as a close of business on June 16th, since then there has been one change. We took out IBM and replaced it with App 11 on July 28th of this year, 2025. And since then, that was a really good decision because if you've been keeping up with App 11, APP is the stock symbol, it has just gone through the roof, as has the overall portfolio. It's mind-boggling that this model that of research and the way Kerry has built his research model, and then couple that with my quantitative model to screen out those companies down to a group, and then using my qualitative model on top of that to screen it down to 12 has produced some insanity returns, like mind blowing. And yet, there has been one change, one trade. There hasn't been any major allocation adjustments. And so that makes it really easy for you, the intermediate to long-term investor, to implement and go live your life. And that's the whole idea behind this is couple incredible research, in-depth research, identifying great companies with incredible growth prospects in the future. Couple that with my mathematical quantitative model that doesn't take in a human emotion based on basically math, and then couple that with qualitative measures and bring it to 12 companies and a risk management process, which is very vitally important because I believe in the next 6 months, risk management is going to be the forefront thing on your brain that needs to happen. You having a risk management process to preserve capital, preserve wins, as we've seen in the Tell Sheet 12. So let me take you through the Tell Sheet 12. This is a public video, so I'm not going to show you what's in it. And the reason is because people pay us $60 a month to get this information, along with Kerry's tell sheet, along with his watch list, along with his daily videos to the subscribers, along with Mark's swing trading portfolios and lists that he puts out every Sunday evening, along with the morning edge that is 7:30 to 8:30 Monday through Friday Central Time, 8:30 Eastern, along with everything else. I have a model portfolio called the 12, which is the top market cap weighted stocks in the S&P 7, as well as the top 5 crypto stocks market cap weighted. And you get access to that along with, golly, anything else we're thinking of. I haven't told anybody this, haven't really mentioned it to the tribe, but I'll say it here. October 1st, I'm going to build a model that mimics the Tell Sheet 12, but using option contracts instead. And I will introduce that in the near future. October 1st, I'm going to use the first of the quarter. That is also, if you haven't upgraded, if you're a member of the starter or the platinum or the premium plan or gold plans, those are going away October 1st. And if you haven't upgraded to platinum, your subscription will run through and then it'll be canceled. If you're new and wanting to subscribe to this, we have a 14-day free trial. You can take advantage of that and learn more about what we're doing, our enthusiasm, our excitement, our research, our just being honest. I mean, Friday's Kerry's call, he was on vacation, and we talked about the differences between the economy and the stock market and what we see coming in the next 6 to 12 months. And it's not what anybody is talking about. And that is your advantage by subscribing to Best of US Investors. So let's take a look at the Tell Sheet 12. I'll give you some performance numbers. I'll take you through the guidelines of it and how it works. This is the Tell Sheet 12. 12 companies screened out using our Carrie's research along with quantitative measures. Let me just take you through the guidelines down here. There's 12 positions selected from Carrie's Tell Sheet 12 portfolio via my proprietary screener. Each position maintains a minimum of 1% at all times. And the reason I hold only a minimum of 1%, no matter if certain rules are broken, is because fundamentally we believe in the companies. The quantitative model that I use to screen out Carrie's Tell Sheet 12 tells me I believe in these companies fundamentally, and that in the long run, intermediate to long run, we're going to see great returns out of them. So we want at least 1% allocation to it. And the reason is because we just don't know when a stock is going to turn from a bad downturn, and we want to be a part of it. Second, the max allocation for each position is 8%. So if you're entering this portfolio, ultimately, as long as certain parameters are met, we will see a 8% allocation. I always suggest that you dollar cost average into these positions as long as certain guidelines are met. For instance, the trade trend line, that's our 15-day period moving average. This front runs the 20-day. Now, markets and algorithms trade off the 20 period moving average. That's my trade trend line, and my 15-day moving average basically front runs the reaction from the 20-day. A little complicated, but it gives you an indicator of where that stock is going, both on the upside, but also on the downside. And it prepares you for possible changes in the future. Our intermediate trend line here is the 62-day moving average. This is my line in the sand. If a stock is trading below the 62-day moving average, I am going to go to a minimum allocation. That can be anywhere from 1% to 4%. If it is below that level for at least 3 or so days, I'm going to implement that potential change. That's how I run my approach to this. You may take a different approach on how you would allocate or not allocate based on some of these changes, but that's part of the process that we help you build your own process. Once a stock trades above the 62-day moving average or intermediate trend line, to us, that stock is on the move up. We're moving, momentum is moving higher. We allocate at least half of our position of the 8% overall is in the position at that point in time. And if it crosses over the 15, so you have above the what we call the Tudor Jones 200, which is the 200-day moving average. If it's above that, above the intermediate, and above the trade trend line, then we have a full 8% allocation and we write it up. We don't really ever make any allocation changes when a stock breaks below the trade trend line. Why is that? It's a very short-term indicator. It can change direction very rapidly. And I believe that it could be a false sell or reduction in allocation indicator. So I want to use it as a way to look at where the momentum, the money flow of these is going. And if it's going into the 62, into the 15, into the intermediate, into the trade trend, then I'm a fully allocated. The momentum is moving higher. But if it starts breaking the intermediate trade trend line, if it breaks the trade trend line, I know to become very cautious, to become more aware. And if it breaks below the intermediate trend line, I know things are changing, because the 62 period moving average, the intermediate trend line, takes a quarter of the trading days of the year. And that tells me where momentum is going. We have a couple stocks that are borderline on this level and have been bouncing around. And come October 1st, I'll reanalyze it and possibly make a change and take the position out. If we don't see any qualitative measures that would say, hey, we need to hang on to this, then we make a change. It's not that all that complicated. I have a scoring system that rates these things. It's proprietary. So we use that. The 200 or the Tudor Jones 200, that's based off Paul Tudor Jones using the 200-day moving average to get himself out of the great debacle of the great financial crisis. It's his borderline, basically anything below the 200, there's just no good that's coming out of it. It's just typically a downward trend. And you can look at long-term charts. And this portfolio is more of a long-term, intermediate to long-term perspective. I don't want to make changes. I just want to use my Carrie's research, couple that with my qualitative screener, and apply my quantitative measures and buy stocks that I can hold for long periods of time. So this is great if you're a financial advisor and you need a more alpha to your portfolios. This is a great addition. If you're a manage your own investments and you need that high beta, more alpha driven side of your portfolio, this is a great addition to that. If you're just starting out and your time frame is a longer term, this is a great way to start out. So as you can see, I've blocked out the individual positions. Reason is because people pay us for this information. I'm not going to cheat them. If you want to be a part of the Best of US Investors, sign up. We have a 14-day free trial. There's a link below in the description. So as you can see here, I have this broken out into trade, intermediate, and Tudor Jones trend lines. I focus heavily on these areas. This is your stock price as of today's market action. And this gives me an idea from a day-to-day perspective, the low end, high end, the differences between today, yesterday's close versus the prior day's close. Does the stock have a lower low? Does it have a lower high? Does it have a lower low? Does the high have a lower high or a higher high? Does the low have a lower high or a higher low? That's what I'm looking for. I'm looking for very short-term trend changes, and this here low end and high end can give me insight to that. This percentage is away from the low end. The stock price is how far away it is from the low end. Gives me that percentage of how far away I am from the low end, as well as the high end. And as you can see in this case, the stock that is in this position is 11.7% dollar. Today's price is 11.070% away from the low end, and it's only 1.16% from the high end projection. So that gives me a sort of a short-term indicator of, okay, this stock is approaching its high. It's day-to-day high. Now, unless I see a continue move up in the projected high end and low end numbers, and this number continues to stay steady, I know there's momentum higher, but it's very, very shallow in a sense. Whereas if I'm looking at this second position, where the low end is at 87.26 projected for the day, potential for the day, and high end of 102.07, stock price is trading at 85.64. Well, this price is lower than the previous day, and so it's down. And this high is lower than the previous day, so it is as down as well. But what I'm seeing here is my stock price is only basically 1.85% away from this low end. So if this low end sustains and I see consecutive, say 3, maybe 5 days of sustaining above this level, then it gives me a potential opportunity to capture the high end, which is presently the stock price is presently 16.10% away from or below the high end projection. So if I'm looking for an opportunity, I want confirmation. I want to see a turn in the low end to a up, and I want to see the high end projection turn as well. And that tells me, hey, I've got some potential opportunity there. But there's a caution, and that's under the trade trend line. And that says here that the stock price today, as of it updates every 10 minutes or so. This stock price is below the trade trend line. That's another cautionary item. So basically, in this case, on today's decision making, short-term decision making is I have more downside on the low end. I have more downside than the high end than the previous day. And my stock price is trading below the trade trend line. So right now, it's a wait and see. That's how I'd interpret that. Now, if I go to this position here, or excuse me, this position here, I'll highlight it. You can see that the intermediate trend line, stock price is below the intermediate trend line. It's also below the trade trend line. This is something I would consider as, okay, I need to possibly adjust my allocation because the low end yesterday is higher than the previous day, so it's up. The high end is higher than the previous day and it is up as well, but it's trading in a very tight range. My stock price is about 2.13% from the low end and 5.46% from the high end. So what I'm waiting for here is this intermediate trend line to change. And I want to see continue higher lows and higher highs. So I'm patiently waiting. So if I'm starting out my allocation, I have 1% in it. Do I add to it? And this is where it comes down to a wait and see, in my opinion. Interesting. We just saw this second position just cross below the trade trend line. It's interesting. Will it hold there? Will it close the day out above this low end? We'll wait and see. All right, so let's look at returns because that's bottom line what everybody focuses on. So we created this portfolio. It was implemented as a closing prices as of June 16th, 2025. And those prices are listed here. Now we had one change here, and I mentioned that earlier. We did that on July 28th, 2025, and we added the position. So this price is based on the price as of July 28th, 2005. As you can see here, if the returns are based as of a return as of entry, so entry of June 16th, and they're equally weighted. So you had a equal weighting of 8% in every position. And so if you look at the returns since inception, we're up 77.01%, pretty awesome by any standard. Year to date, if we were to go back in time and go implemented this model back on January, first trading day of the year, we would see that this portfolio with the changes as well is up 95.89% as of this recording. That's insane. It's substantial. But I do believe it's a lot to do with the initial research that Carrie has done, screening out using my quantitative model and then using qualitative measures to figure this out. I broke down June's returns, great month in June. I believe that's a recovery month after the bottoms in April. Then July, we mellowed out. We were up 12.57%, August up 16.48%, and now month of September, and we've got 11 days, 10, or actually less than that, till the end of the month, and we're up 20.28%. Now, if you're entering this portfolio today, you don't get to adopt these returns. Sorry. But this gives you a starting base to start from. And I always suggest if you're going to use this model and you're going to commit to it, start with a 1% allocation to each position. And as we see movement higher in the portfolio and confirmation, you start to dollar cost average into the full 8% of each position. Now, we're at the end of the month. This is September 23rd, 2025. This is going to be interesting as we get into the beginning of the quarter. And that's when I go, hey, start small and spread. And then as we enter the first of the quarter, start to look for opportunities to dollar cost average in. When do I make changes? Well, I usually announce them on the morning edge, October 1st, prior to, well, before the close of October 1st, I will have screened both Carrie's his list, any additions to the list using the qualitative model that I use, and then I'll make a decision. Should I replace a couple positions? There are a couple positions in the portfolio that I do and have had some questions about over the last 2 months. They're not performing as well as I had hoped. I want to know why, and that's more of a qualitative side of things. And I want to see how Carrie's tell sheet ranks these positions that I'm questioning at that point. So that's how we do it. That's how the Tell Sheet 12 works. It's very easy to implement. I designed it for those who are more intermediate to long-term investors. After 25 years as a financial advisor, I came away with a couple things. I had sold my business to my business partner, got out back in, well, actually, it's about 23 years as a financial advisor. And I walked away saying, the model that the majority of financial advisors take is a diversification to mediocrity. One of the greatest investors in the world, Warren Buffett, said, you own 1 million stocks, you're basically asking for mediocrity. Concentrated in certain positions with good fundamentals, good quantitative measures, and good qualitative measures can produce incredible, well risk managed returns. And that's what this is about. Going forward, I'm excited about what we're going to do with this. I'm excited about the new subscribers to the Best of US Investors. And I encourage you to try the 14-day trial and jump on our morning edge call. Jump on Carrie's Friday call at 3 o'clock Central, 4 o'clock Eastern. Learn more about what we're doing. Join our Discord. That's part of your membership to Best of US Investors, and interact with the community. More and more, we're going to be doing really, really cool things like a leap option version of the Tell Sheet 12. More on that to come. I really appreciate you all hanging in there and going through this explanation of the Tell Sheet 12. I hope you're having a wonderful year, and I hope you have a wonderful, wonderful end of the quarter and your investments continue to skyrocket higher. But most importantly, I need you to do this: two things. One, subscribe to the Best of US Investors. Click the link in the profile. Try us out for 14 days. Number two, and most importantly, always, always live loud.